This is Satya Prediman of Cirrus Research. I want to give you a heads up to our Cirrus Signals report. This month, the report flashed fairly relevant changes. The title, Sell-Off Allows Risk Aversion Model to Portray a More Constructive Equity Market. This is a very uncomfortable statement in the environment we're in, considering the massive sell-off we witnessed in January, but also looking at the very weak pullback periods in the fourth quarter. What I want to do is walk through the Cirrus Risk Appetite reading. I think that's crucial to these changes that we believe that we're now witnessing. The CRX, as we call it, the Cirrus Risk Score, it's basically a risk appetite model. The purple line here that you see represents the US readings. The dark blue reading represents Canada. The light blue reading represents Europe. And what this is suggesting is several key markets around the world, we've witnessed risk appetites truly plummet. The important takeaway is that this is a really valuable contra signal. When risk appetites are sprung really high, that is a time where you're going into a riskier period. Subsequent 6-12 months later, markets tend to be lower. We also tend to see a break in leadership, momentum factors break down. When you're at this lower rung, the bottom line is the forward 6-12 month numbers seem to be the highest expected return in equities. In other words, where we're at right now, it's fairly noisy, turbulent, scary. At the same time, what this is saying is that investors have been acting on their fears. And what's notable this month is this is the first month in the last 3 where this has broken through some meaningful number and has started to reverse course mildly. So we think we should be really strongly considering how to reposition in this market. In a way, this is a get into ready mode. One of the real implications here is that factors like quality and value, they seem to work really well as risk appetites bottom and they start to revert. Another model that we run, which is our Cirrus asset allocation model, this is interesting because this had been bearish into late last year. And in the last 4 months, we've begun to see the equity readings really reverse course. So what we've got right now is a reading of 38% allocation equities, which was much higher than the, let's say, 10-12% reading 5-6 months ago. And so we think this is important because as much as there is a huge amount of interest rate risk in the environment, at the same time, what we are also seeing is that credit spreads remain benign. In other words, profitability for firms do not appear to get shaken as much here. And so when you look at the bond market, when you look at credit markets and profitability, these things are starting to add up to a more constructive market. This just got a lot more interesting because risk appetites have begun to reverse course. So finally, again, we're still in this sort of overweight fixed income world, but the big change here was this risk appetite reading. It's truly defensive. It looks as if it's bottoming, going into potentially the highest expected return market. Thank you.